Hey there guys, how's it going? My name is Chris Chillingworth. Welcome to the FTSE Show, the show dedicated to the financial and I guess fundamental analysis of UK FTSE stocks. Today we're going to take a look at an airline company. Airline companies are struggling right now. You've probably seen news in the press regarding a massive influx of people wanting to travel all of a sudden now that we've pretty much waved goodbye to COVID. And they're all jumping on planes, and the plane companies just cannot cope with the influx. And lots of people pointing their finger of blame towards different institutions and the airline companies themselves and the passengers and the government. But passenger numbers are clearly rising, and I wanted to take the opportunity to have a look at an airline company. Now, I've looked at lots of different airline companies. I've analysed over 1,000 FTSE stocks now, from the FTSE 100, the 250, the small cap, to the FTSE fledgling index, even the FTSE AIM markets. So I've seen a lot of airline companies from that list. There's a few. And this is a company today that I want to look at that, historically speaking, have been looking really good, looking like a really good, solid airline company, very profitable, doing very well for themselves. So I thought, what a great opportunity to sit down and have a look at this company and do an episode on it. Very quickly, before we dive into that, I just want to say a couple of words. The analysis that I do is for me, but I share it with other people. And if you're a successful investor, you'll understand the value of analysis. If you don't have the time to do that analysis, then there is an opportunity to come and join the SUSSEX Investment Club. We've opened the doors. We're looking for some more people to come and join us. If that is something that might interest you, all I'm suggesting is in the description below this video, there's a link. Click on that, have a read. If it's something you want to get involved in, then the instructions are all there. If it's not for you, totally fine. Okay, so let's take a look then. This is a company called Wizz Air. They are a Central and Eastern European low-cost airline. So they're kind of in there with Ryanair, EasyJet, the kind of low premium, low cost, low ticket price airline company, but they focus on Central and Eastern European destinations. They had 40 million passengers as of 2020. Those numbers have dropped obviously since the lockdowns. In 2021 they had 10 million passengers. In 2022 they've just reported, literally today they've reported 27 million passengers in 2022. So obviously that's the year ending up to 2022. So I think we're looking at March to March, but I might be wrong about that. Don't quote me on that. But anyway, what the point is here is that 40 million passengers before the pandemic, and we've gone down to 10, then back up to 27 million. So it looks like passenger numbers are rising, which is the sort of thing we're seeing in the press. They are struggling to cope with these numbers, though, despite the fact they're nowhere near the volume of what we were seeing in 2019. So, and that's due to apparently laying off a load of staff. So, they carry 1,000 different routes across 42 different countries. So they're quite well established. They closed Wizz Air Ukraine back in 2015, and that was amid rising political uncertainty. So they were well ahead of the curve on that one. Obviously, a lot of companies have now ditched their Ukraine businesses and their Russian businesses amid all the war and everything. They floated back in 2015 at £11.50 a share, now trading at £25.75 a share. So, yeah, they've done pretty well in the last 6-7 years in terms of share price growth. And that reflects the underlying financials that we're about to see. They hold the youngest fleet of any other airline, 150 aircraft. That's important because of maintenance and depreciation costs. They don't have the same level of that as other airlines do because their fleet is a lot newer. And so they're not retiring planes left, right and centre like some of the old established airlines are. They will have to in the future, of course, but right now they have the youngest fleet of any other airline. They consistently win the low-cost airline of the year, They deliver the highest profit margins of any other European airline. That's as of 2018. I believe it also applied in 2019. I don't know if it applies in 2020 and 2021, 2022, because I haven't had the data to be able to compare with the other airlines right now. So, but they've got a history of being the most profitable airline company out there, certainly across European airlines, I should say. They have consistently won the highest 7-star rating in safety by airlineratings.com. They have a 39, so let's say a 40% market share in Central and Eastern European flights. Ryanair are behind them with 32% and EasyJet have 6%, just in that region. And they've managed to continue a freight service throughout lockdown, allowing it to continue to bring in revenue. So when they weren't able to fly passengers during lockdown, they were still flying freight, so cargo and things like that. And that's part of their business. They've got a kind of cargo arm of their business. And that wasn't planned for COVID, but because they had it, it allowed them to continue to bring in some revenue during the time when most airlines were just hemorrhaging cash just because of their expenses and no revenue coming in. Okay, so let's take a look at the analysis then. Let's dive in. So, little caveat here before we start. We've got no data for 2013 because they didn't float until 2015. So we go back to 2014's data. And then if you look at 2022, today, they've just announced 2022's data. There's no annual report yet. It hasn't been published. Probably looking at another month before that comes out. But they've released the data in terms of the financials. But there's only a little bit of financial data. It's like a summary that they release. And they give you the kind of headlines of these numbers. But we've got to wait till the annual report comes out till we can really have a look at the CFO's reports and look at the numbers properly. So we've got it highlighted in yellow here because it's preliminary data, it's early data. We've had to make a few assumptions here and there. It may not be 100% accurate, but revenue's accurate and profit is accurate. So that's the key information. So what we can do is we can look at 2014 to 2021. And as you can see here, between 2014 and let's say 2020, this is a company that actually were doing really well, really good growth from 1 billion revenue in 2014. And that has just risen year after year after year up to 2020 to 2.7 billion. So that's some really good growth. And this is what I meant at the beginning here with regards to Wizz being a strong airline business. Out of all the other airlines, Wizz are one of the strongest in terms of profit. And certainly you can see that reflected in at least the early stages of the revenue here. Now, obviously, then lockdown kicked in, and this has lagged somewhat because the 739 million revenue that came in 2021 would have been for March 20 to March 21, that period. So that's why it kind of it looks like it's lagged a little bit. But certainly hit in 2021, went back to lows of well before their float, you know. So that's one of the worst years they've had, and understandably, as we understand what's happened in the press there. So yeah, revenue hit, and then in 2022, the 1.6 billion that's coming in, that's pretty much confirmed as of today. So we can see that things are improving, but we're still down before 2018's kind of returns and revenue coming in. So still a long way to go, but improvement. Things are improving. Unfortunately, it doesn't look like it's probably going to be enough right now. If we go down to we ignore cost of sales, there's nothing there. So gross profits exactly the same. Gross profit percentage is 100%. So ignore all that. Go straight down to expenses. Now, expenses, as you can see, historically, expenses have been pretty high at about 80 to 85% of the gross profit. That is high for me. When I'm looking at companies, I don't like to see a company where expenses are that high. One of those reasons for that is because all it takes is a spike in expenses to wipe out your profits for the year. You know, if you have a 15% increase in expenses one year, boom, there you go. You've got no profit left over, basically, or nothing left over for profit. And then 2021, as you can see, whilst revenue plummeted to 739 million, the expenses, whilst falling, did not fall anywhere near as much as the revenue did. And as a result of that, the expenses came in at 124.7% of the revenue, leaving them with an operating profit of minus 500 million. Ouch. So that was a painful year. They lost 500 million in profits, basically lost it. I should say they made a loss of 500 million. So that's painful. And then in 2022, this information we can pretty much be happy with as accurate. The expenses are coming at over 100% again of the profit, but not quite as bad as 2021. Still making an operating loss of 465 million. So only just shy of last year. So things, whilst revenue has improved, the costs of running the business have gone up just as much, almost. And as a result of that, they really haven't still made much profit, which is bad. That's not a good sign. When I saw that 2022 data come through, I was quite disappointed, really. I really would hope that they would be at least making some real strong grounds towards getting to break even. But that's not a good sign for 2022, and I'm not hopeful about that, to be honest. But as you can see, from 2014 to 2020, profit was looking really good. It's still doing pretty well. By 2020, they were making 338 million a year in revenue, in operating profit. But it was consistent in terms of 2014 to 2020, making profit every single year. But on top of that, it was growing. That profit was growing every single year, and that's beautiful. It's exactly what I'm looking for as an investor. I want to see companies that are growing in profit every single year. Let's have a look at the earnings analysis then. Again, 2022 data, very sketchy on this. We don't really get given that much information until the annual report comes out. But we can look at you've got the operating profit across the top here. We've got the finance expenses on the next row. That's the interest that they pay on debt, stuff like that. Sale of assets, nothing to speak about there. Other income, who knows what other income is? I hate that term. I used to work with a load of accountants, and whenever you would have a section that said other, they would hate it because they want everything accounted for. And what does other mean? You know, it could be anything. It could be dodgy dealings for all we know. Who knows? We've got 2020, 254 million in other income deducted. So it's actually a cost of 254. It could be something to do with the pandemic, but we don't know. So awesome. But it's there, and it helps colour what's going on and tells us what's going on at least. Then we've got taxes. Nothing you can do about taxes. You've got to pay what you've got to pay. So and we trust that they're paying what they're supposed to be paying. That's down to the tax man to chase them. But then we've got reported profits and true profits. The difference between that is obviously the reported profits are essentially what the company have reported in their releases, and saying we made this amount of profit or this amount of loss. The true profits is basically erroneous, non-everyday costs or profits being taken away. That's something that I've done. So, and that's what I prefer to look for. And then we've got the profit percentage underneath that. So as you can see, from 2014 to 2020, this was a very profitable airline. These were guys that were making between 13 and 15% profit margin a year consistently, and it was looking really solid. However, a couple of trends here that are noteworthy for an investor. 2017, they made 15.7% profit margin. So we had the revenue that came in and the costs that were left, and then the leftover true profits, 246 million, represented 15.7% of the revenue that came in. In 2018, the profit that they made was higher, so it went up to 276 million, but it only represented 14% of the profit of the revenue. So a downward trend there. Then in 2019, that's fallen to 12.7%. So again, revenue's gone up, profits have gone up, but profits have not gone up as much as the revenue. And as a result of that, profits fell to 12.7%. In 2020, they fell to 10%. So you see here from 2017, 2018, 2019, 2020, profits have fallen per year. The money left over from the revenue that came in, bear in mind revenue's been growing, the profit has not been growing as fast as the revenue essentially. And we've dropped from a company making 15, nearly 16% profit margin a year to 10%. And that was by 2020. So that was before the pandemic. And then the pandemic hit, And this is a company on a downward trajectory from 2017 onwards. That's one thing to note. But then when the pandemic hit, they were just destroyed. I mean, destroyed might be a heavy word, but 576 million, over $500 million in losses in 2021. And I can confirm as of today, their press release that came out today have announced that they made a 642 million loss in 2022. So it's got worse. Revenue's gone up in 2022, or for 2022's data, March 21 to March 22. Revenue's gone up, but obviously the cost of running the business have gone up so much more that it's added more losses. They made more losses in 2022 than they did in 2021. That's a bad sign. I mean, I'm not sure what that could be. There may be some other costs that came in, or expenses may have gone up more than we thought. I don't know, and we won't know until the annual report comes out. But that is a confirmed number, as in the 642 million in losses this year is confirmed, and that's at euros. Everything's done in euros here, not pounds. But 642 million lost. So that's not working in the right direction as far as I'm concerned. That's a bad sign. Let's take a look at the debt analysis. So we've got the true profits on the top line here. We don't know what the debt situation is for 2022 yet until the annual report is released. Short-term borrowings. Everything looked great up to 2020. In 2019, things looked really good. There were no issues with debt. They were hardly borrowing anything. Then in 2020, they took on 340 million worth of short-term debt. That's got to be paid back in a year. Short-term, within a year, that's got to be paid back. And then 1.67 billion in long-term borrowings from 2.1 million. So they were borrowing 2.1 million in 2019. They jumped to taking on 1.67 billion in 2020 in long-term debt. Now they've got years to pay that back, or over a year, but still, that's a lot. And when we look at the earnings to debt ratio, what were they earning? They were making about there's a company that in their prime were making about 281 million in profits. And they've just taken on 1.67 billion in long-term debt and 340 million in short-term debt. That's a concern. But on its own, it wouldn't necessarily cause me to run a mile, but it's definitely a concern for me. What's more of a concern is 2021, because as you can see, those short-term borrowings then went up to 722 million, and the long-term borrowings went up to 2.4 billion. So combined, you're looking at about 3 billion, just over 3 billion in borrowings for a company that in their best prime were making 280 million a year. So that's going to take them 10 years to be able to pay that off, 10, 15 years to pay it off. I mean, I don't know if they're expecting some sort of big windfall of cash coming in, but we're talking billions. Where's those billions going to come from to pay off that debt? I don't know. Company were making a loss of 500,000 in 2021. So not only have they taken on all this additional debt, but they're now not only not making 280 million a year in profits, they're making 500 million a year in losses. So now things look ugly, absolutely ugly, because now we've got 3 billion in debt and a company making 500 million in yearly losses. How are we going to pay off that debt? And I wouldn't be surprised if a big chunk of those losses are off the back of interest being paid on that debt. Because that's going to be, from 3 billion, you've got to be looking at 100 million in interest. And we'll find more out when the annual report comes out. And I might be wrong, but there's going to be a lot of interest on that level of debt. And so that's going to eat into your profits. There's going to be an additional expense, an additional liability. So, yeah, that's a big concern for me. And as an investor, we actually had Wizz as one of our companies in the Sussex Investment Club. This was a company we were looking at. We ditched them in 2020. In November 2020, we ditched this company because we saw that trend going down and we didn't like it. And we're so happy we did. We're so happy we made that decision, because obviously then lockdown came in and this airline just went boom. That's just I don't know what they're doing. Obviously they've got to take on this debt for a reason, presumably to survive. But it's obviously hit them that hard that they needed to borrow $3 billion. And that's, for me as an investor, a major concern, unfortunately. We take a look at the equity of the business. So we've got the assets along the top here. We don't have any data for 2022. We've got the liabilities underneath. So assets are everything that they have that brings money into the business. Liabilities are everything that's costing them money. And underneath that, the real key information here is the net worth. So that is the assets minus the liabilities, what's left over, what's the equity. And as you can see, from 2014 to 2019, the equity in this business was fantastic. From 159 million in 2014, this is a company that grew to being worth 1.5 billion in 2019. So over the course of 6 years, they've grown from 159 million to 1.5 billion. In terms of size, that's their assets that they own minus their liabilities that they owe, leaving the 1.5 billion in value. In 2020, that's dropped to 1.2 billion. In 2021, that's dropped to 903 million. So the value of this company, whilst assets are rising, liabilities are rising far faster than that, and their net worth has been falling the last few years since 2019. Now, one would be very interested to know what that number is for 2022 and where it's going. I would worry that it might be going down even further with the additional liabilities that seem to be taken on every year in terms of the debts, and assets may not be rising, or might not be rising as much. And then underneath that, we've got our retained earnings, and the retained earnings essentially what is after dividends are paid, after what profits are left and kept in by the business. Think of it as a pot, and every year we get a snapshot of what's sitting in that pot. And that number has been falling since 2019. It was 1.3 billion. It's down to 700 million now. This is all bad trends. This is all bad trends moving in the wrong direction. Now, we've got mitigating circumstances here because obviously of the lockdown in 2020 and 2021, they have caused what was a company that may have continued growing beautifully in 2020 and 2021 to have to be struggling now and to have to take on all this extra debt. But that is still the case. There's not really anything we can do about that. And as an investor, we need to be mindful of, okay, what are the questions here? Well, we've got a company here that are looking like they're getting back on track in terms of passenger numbers. They're struggling because they don't have the staff. They're looking at bringing on more staff. That's going to be additional expenses. But obviously increase revenue as well. But all the trends are moving in the wrong directions. It's a company that's taken on far too much debt. They're making more losses than they were making in 2021. How are they going to pay that debt off? That's a real concern for me. And yeah, I'm honestly not sure how they're going to do it. And as an investor, when I'm looking for a company I want to invest in for 5 to 10 years, there's too much worry here. Will the airline industry get back to doing well? Probably. I would imagine they probably will. People want to fly, people want to travel. With the pandemic pretty much gone, things will get back to normal. And this is a company that probably out of all the airlines are probably the better airline to invest in out of all the others that are out there, in my opinion, based on the numbers. But if I was to put this up against some of the other companies that I invest in now that I've found for the Sussex Investment Club, they don't. There's no comparison. There's no way this is a better option than the options that I already have. And so for that reason, I wouldn't invest personally. Looking at pricing is going to be really difficult to do because today's share price is £25. They've never paid a dividend, by the way, not in their history. They've never felt like they were in a position to do so. That may have come later down the line, but I can't see them releasing any dividends for a long time now with that debt level that needs to be paid off for a company making a loss of 600 million a year. I don't know how they're going to do it. But in terms of price and analysis, we can price them based on 2020's data, so pre pre-pandemic prices. And if that was the case, and we were looking at, okay, this is the earnings per share that the company are making, this is the net assets of the value of the business, this is the share price, this is how many shares are currently in circulation, I would work out essentially that today's price was actually cheap. And I would be willing to pay probably up to £36 for a share in Wizz Air. However, that was based on 2020's data. We've had 2021 and 2022 now coming in, and this is a company making losses. So how can we, if you were to invest in a company, you would want to see some sort of a return, right? So initially, if you bought Wizz Air, you'd straight away take on their net assets. You'd own all their assets, all their liabilities, and you'd instantly own their net worth, right? But on top of that, you want a company that's bringing in some sort of income. You want a company that's bringing in, like when you buy stocks and you get dividends coming in. If you're going to invest in a business, you want profits every year. Okay, you want to be bringing in some sort of, when you own a property, when you buy a property, you pay off the mortgage with the rent, and hopefully you've got some left over for you, and you can make a profit, make it a passive income, if you will. Well, if we were to buy a business that, yes, has a net worth or asset value or equity value, great, but we want some sort of income, and that's the profit that they're making every year. Well, Wizz aren't making any profit. So you're not going to be getting any profit. If you were the sole owner of Wizz Air, you'd be hemorrhaging losses of 600 million a year. So, yeah, that's basically when I then work out how much I'll be willing to spend on this company, the answer is nothing, because I can't calculate a price based on a company that aren't making any profit. They're losing money. So therefore, I wouldn't spend anything on them. And so for now, my pricing analysis would suggest I wouldn't spend a penny on them. And that's just the way it is. We've got some information. You might not be able to see this slide very well, but this is the June 2022 update. So this came out this morning. So cutting edge news here from the FTSE Show. So Wizz Air on Monday, that's a couple of days ago, reported soaring passenger numbers for May as travel started to recover from the pandemic. Wizz carried 4.1 million passengers, so that's just for May, a 390% increase year on year at a load factor of 84%. I don't know what a load factor of 84% means. I wonder if that's potentially the load or passenger load per aircraft, perhaps. I'm not sure. If you know what that is, leave a comment underneath for me and tell me. But and then it goes on to say, low-cost airline Wizz Air said it expected to make a first quarter loss despite strong summer demand as it deployed extra resources to minimise disruption due to staff shortages and supply chain issues. The airline reported a loss of €642 million for the year to March 31st, 2022, compared to a loss of only €576 million only a year earlier. Planned capacity growth for the first two quarters of the current fiscal year is more than 30% and 40% respectively. So I guess they're looking to add to their fleet so they can take on more capacity. That's going to cost them money though. The industry has seen widespread chaos in recent weeks as bookings have surged, leaving short-staffed airlines unable to cope, resulting in hundreds of flight cancellations. Bad business. The industry is witnessing supply chain issues across airports, including in our network. This is a quote from them, by the way. Shortages of staff in air traffic control, security, and other parts of the supply chain are impacting airlines, our employees, and our customers directly. This is Chief Executive Joseph Ferradi. We are deploying extra resources to minimise disruptions and urge all other stakeholders to do the same, having customers' best interests. We don't care about that. Variety. When I read annual reports, I swear 90% of it is just what I call guff. It is just rubbish. It's just jargon. It's corporate speak, and I can't stand it. I read it and I'm like, okay. Having customers' best interests is always, it's nothing to do with the profit. Variety said that the sector remained exposed to externalities such as air traffic control disruption, continuing operational issues within the airport sector, and in a volatile macro environment. as a result, it's pulling its full year financial guidance. So every year they'll say, we think we're going to make this kind of money. This is what to kind of expect from us. And they basically pulled that back now and said, we don't really know what's going to happen. Bad sign. If they don't know what's going to happen, we certainly can't predict it. And it's generally a negative sign. And share prices, the share price, which is at £25 today, has actually it's there because it's fallen 8% just on today's news. So it's down about 10 to 8%, I think it is. So looking at the scores, they're right at the bottom. Unfortunately, this is a company that previously, before pandemic, probably would have scored something close to 60 points on the clear score mark. They're down at minus 127, and that's mainly because of that debt. Mainly because of the vast size of the debt they've taken on relative to their negative earnings power. So they're down. They're losing 650 million a year right now. Let's say that things recover, and it takes them 5 years to get back to get back to, let's say, 100 million a year. Well, then you've got a company making 100 million a year that's got at least 3 billions worth of debt to pay back. Well, that's going to take you 30 years. So, yeah. Once you go down the slippery slope, now we've got the issue of, yes, we need to get back to 100 million a year profit, but we now have the interest on that 3 billion to pay, to contend with as well, which we didn't have before lockdown, before the pandemic. So, yeah, this is a company making previously, 280 million a year, but now on top of that they're going to have to pay interest on their debt every single year, debt which seems to be increasing on a yearly basis, and yet they've got to find a way to make profit to be able to pay down that debt. That's difficult. I can't see how they're going to do it personally. It worries me as an investor. It certainly worries me, with a 5 to 10 year outlook, and I would suggest that there are better options out there for your capital. So yeah, that's where we're at. If you've got anything to add, if you know anything that I've missed, if you have any opinions on this whatsoever, leave a comment underneath the video, and I will generally get back to everybody who comments. But thank you very much for watching the FTSE Show. I hope you have found this useful, and I will see you guys in next week's episode. Cheers.